It seems that an infinite number of complex charts have passed through the media to show that the bubble of everything continues to inflate. This can distort the fundamentals and lead to false market confidence. However, most of the time, simple is better. And that's why it's good to check on margin debt every once in a while because it's simple. So let's take a look. Margin debt is the amount that individuals and institutions borrow against their stock holdings and is tracked by the Financial Industry Regulatory Authority, or FINRA. And looking at this chart from advisor perspectives, you can see that margin debt has soared to record levels since the pandemic lows of 2020. And this is a relatively simple indicator of stock market leverage. And as you can see, turning points in the S&P 500 develop when margin leverage is unwound. And according to Steven Sutmeyer of Bank of America, there have been about 21 margin debt peaks using FINRA and global financial data going back to 1929. Sutmeyer has determined that the S&P 500 generally trades weaker after a margin debt peak. So that doesn't necessarily mean a crash, just weakness. On the other side of the coin, right now, the major indices seem to be looking fine, but it's always a good idea to keep an eye on margin debt. Using another chart here, also from advisor perspectives, because of data collection delays, these charts are about 1 month old. And as you can see in the upper right of this chart, FINRA reported that July was the first decline in margin debt since the bottom of the equity market in March of 2020. And FINRA margin debt fell to $844 billion from a record high of $882 billion in June. And going back in time, you can pinpoint major S&P 500 tops that were put in during the dot-com bubble and the peak of the Great Financial Crisis when margin debt reversed. Following the Great Financial Crisis, there have been 3 instances of drawdowns in margin debt with corrections and then immediate V-shaped recoveries. And also, as you can see, the rising leverage tends to confirm U.S. equity rallies. But it's not new record highs for margin debt that we need to be concerned. The concern is when margin debt stops rising. And this suggests that investors have begun to reduce their leverage. So in June, margin debt peaked and then reversed in July. And this is only a concern, not a crash. And again, these charts are not necessarily great for market timing, so don't try to do that. Just remain patient and prudent, and oh yeah, watch this week's market update. And for today, that's ChewDog Charts. Thank you.